What's happening to American budget carriers? Unless you closely watch airline business news, you probably missed a story announcing that Southwest Airlines was going to start allowing their flights to be posted on Expedia. And then we found out that Southwest's famous first come, first served seating policy is being replaced with a new guaranteed seat selection option. And even their famous free checked-in bags are being abandoned. So what's going on? The changes at Southwest and its competitors mark a significant departure from the classic business model for low-cost airlines that goes back decades and has always set these airlines apart from their full fare competitors. But this raises the question, if US budget airlines like Southwest are changing what makes them famous, does that mean the segment is going away entirely? And what will the major carriers do to respond? What does it mean when American budget airlines are struggling while European ones excel? Let's find out. The low-cost model in the United States took off after the 1978 Airline Deregulation Act, which removed government control over fares, routes and market entry. This opened the door for new airlines to compete on price, efficiency and service innovation. Southwest Airlines became the poster child of this new era, proving that a no-frills, point-to-point model and low fares and high aircraft utilisation could be profitable. Their relentless focus on streamlining and the use of a single aircraft type helped them ride this to huge success in the 80s and 90s. Having a single aircraft type provides huge operational benefits. It means that all the pilots are qualified to operate all of the aircraft. So if an aircraft gets stuck down route somewhere, any of the airline's pilots can be rostered to go and fly it back. And this also makes flight crew, cabin crew and engineering training so much simpler. And this can reduce delays and means that airlines can negotiate volume discounts on planes and spares, keeping costs down, not just when they buy the planes, but across their entire life. Now, of course, the key to this model is getting planes full and in the air as much as possible, as this is where they're making money, and is in fact the root of Southwest's unique first come, first served seating style, where passengers picked whichever seat they wanted, helping reduce turnaround times. These changes allowed these new airlines to become true giants. Southwest's fleet, for example, has 800 aircraft, and Ryanair's fleet of over 600 make them some of the largest airlines in the world. And in Frontier and Allegiant and Spirit all have more than 100 each. But before we get too deep into this, I want to talk about a few of the different types of budget airlines and how they all fit together in the market. Generally speaking, the pricier options tend to be the major airlines and flag carriers. These airlines focus on fancy reward programs, global reach and perks for their most valuable customers, business travellers. These airlines are usually based at hubs with nearly all of their flights either starting at or finishing at a hub. At the other end of the spectrum, ultra low cost carriers like Ryanair, Spirit and Allegiant take a much different approach, making their base fares as low as possible whilst charging for everything else, including carry-on bags, refreshments and seat selection. This allowed these airlines to serve smaller markets, thriving on the lower costs of using smaller airports. They aggressively target underserved areas of the country and focused on the budget traveller. Vacationing families and students, for instance, make up a much larger portion of these airlines' customer bases than they would a major legacy carrier. So that's the two extremes. But in the middle then is a third, more nebulous category, the leisure airlines. These airlines follow some of the same strategies as the ultra low cost carriers, but with some key differences. Instead of obsessively focusing on a single aircraft type and engine choice, some have a mixed fleet of aircraft. JetBlue, for example, flies A220s, A320s, A321s, and even some smaller Embraer E190s. Some of them even embrace a more point-to-point model and generally focus on vacation and personal travellers while still offering some of the conveniences that the larger airlines offer, including some options to book continuing flights on a mainline carrier using the same reservation system. Alaska Airlines went even further in 2021 by becoming a full member of the One World Airline Alliance. These airlines sought to be cheaper than the mainline, but also set themselves apart with an approach that focused more on unique touches and exemplary customer service for their passengers. A key part of the strategy for Southwest was controlling how customers booked their flights. Southwest refused to list flights on third-party travel websites, forcing customers to book directly with its site. This helped the airline avoid paying commissions to online travel agencies while also maintaining control over pricing and branding. People flying on Southwest didn't just pick the lowest fare from a spreadsheet, they went out of their way to pick Southwest. Ryanair too has had its fair share of fighting with third-party sites, announcing in January of last year that they wouldn't allow these sites to list their flights because they believed these sites were adding markups and fees that they didn't like being passed on to the passengers. So for low-cost carriers, the strategy of offering only basic services and charging extra for everything else has worked well for them for years. It kept their fares dramatically lower than mainline competitors and allowed them to carve out a profitable niche in the industry, a really profitable niche. Southwest had an incredible streak of success, earning a profit every single year from 1973 to 2020. Remember that, as we'll come back to it. But business is a cat and mouse game of constant adaptation, and eventually the mainline carriers caught up. They realised that they could offer their own lower cost basic fares with nothing included. These basic economy fares were close to those of the low cost carriers, but included some of the perks of a global mileage program and the ability to continue on to international destinations in Europe, Africa or Asia if a passenger chose to do so. These mainline carriers could continue to place downward pressure on the budget airlines because they could subsidise the cost with premium and business travels, many of whom would book last-minute high-fare tickets, as well as expensive airport lounges and onward flights to their true cash cow, premium international travel. This financial cushion allows full-service airlines to compete aggressively on price with perks that low-cost carriers just simply cannot offer. Another advantage that low-cost carriers have historically relied on is higher aircraft utilisation rates compared to their legacy counterparts. By turning planes around quicker and flying more sectors per day, low-cost carriers could spread expensive fixed costs like aircraft leasing across more flights, making each flight cheaper to operate. And it was this operational efficiency that gave them a key competitive advantage, especially against full-service airlines with slower hub and spoke networks. But that reliance on utilisation becomes a major vulnerability when things go wrong. For Spirit, engine issues with the Pratt & Whitney GTFs have forced dozens of planes out of service, gutting their entire schedule and revenue. And similarly, Southwest has struggled with Boeing 737 MAX delivery delays, forcing them to keep older, less efficient planes in service longer than planned. And when utilisation drops, the maths that make low-cost models work starts to break down, exposing how fragile the system can be. Now, I know you're going to have the urge to skip this, but just give me one moment. You've no doubt seen 1,000 NordVPN ads by now, but I'm going to share 3 ways NordVPN keeps you secure that I bet you didn't know about. First, there's their dark web monitor. This thing literally scans the parts of the internet where stolen data is sold and alerts you if your information shows up. That way you can get ahead of the scammers by changing your password or cancelling a credit card. But this next one will appeal to you jet setters even more. Ever been on a trip and needed something from your desktop back home? Well, Nord's MeshNet feature lets you do so securely from anywhere in the world with no cloud storage needed. And last but not least, Nord also reduces the chances of your data getting stolen online. Their Threat Protection Pro feature actually alerts you if you're about to click on a scammy site and blocks phishing attempts by 85%. You know the drill, scan the QR code for 4 months free when you sign up to the 2-year plan, or head over to nordvpn.com/mentor now. If it's not for you, they've got a 30-day money-back guarantee, so it's literally risk-free. Thanks to NordVPN for sponsoring this video. Now, let's get back to the story. In 2020, when the COVID-19 pandemic shut down global air travel, airlines had to park entire fleets for months and deal with reduced demand for years. Low-cost carriers like Allegiant, who actually owned more or less their entire fleet, were able to bring aircraft back online only as needed, staving off some of the worst of the damage, while Southwest, with their massive fleet of newer 737s, lost out. Now, of course, everybody posted losses in the pandemic, but for Southwest, 2020 was the first time they posted a full annual loss since 1973. And it's ironic that the same choices that these airlines made to save themselves money have also been the undoing for some of them. You see, having one type of plane and one type of engine is a bit like only growing one kind of produce. Sometimes you could have a bumper harvest with so many blueberries that you're turning purple, but other times you get a drought and lose the entire crop. And that is what more or less happened to Southwest with their entire airline built around the 737. For decades, they had aggressively sought volume discounts with Boeing by making huge orders for the newest planes, banking on their superior efficiency and reliability to make up for the expensive payment to lessors and finance companies. But the groundings and delays of the 737, specifically the 737 MAX 7, have cost Southwest dearly, with their stock badly underperforming compared to their mainline competitors, something Southwest directly attributes to the delays in the 737 MAX deliveries. Now, we have talked before about the changes that are being brought to Southwest by active investors, and these are ongoing. But Southwest aren't alone in this. Similarly, these same types of problems have affected Spirit Airlines, as the A320neo engines from Pratt & Whitney have caused no end of headache, as we've also discussed before. And in India, Go First declared insolvency in 2023 over issues it was having with those very same Pratt & Whitney engines. Now, separately, while the major airlines were squeezing these carriers on margin, passengers have grown weary of these same low-cost carriers squeezing them, literally into seats with less legroom and complicated pricing and boarding systems. And many passengers demand more nowadays, and lower low-cost carrier revenues, in the United States at least, seem to support that. However, it looks like low-cost carriers are trying to adapt. But how? Well, Spirit, for example, once the poster child for charging for every conceivable add-on and the smallest seats, has introduced larger, more comfortable seats in the front of its cabins. This move signals a willingness to cater for travellers willing to pay a little bit more for comfort. And Spirit has also tested bundling prices for customers who prefer a simple fare over the a la carte experience that made them and the ultra low cost carrier model famous. And these experiments mark a significant shift in strategy, aiming to appeal to a broader range of travellers. In another shift, JetBlue, though not a traditional low cost carrier, has also moved into premium territory with its Mint service. On long transcontinental US routes, JetBlue now offers lie-flat business class seats, which they call Mint suites, and while these are smaller than the ones offered by the major legacy carriers on their wide-body aircraft, they are nonetheless an impressive feature on a single-aisle Airbus A321LR and provide an experience that competes directly with legacy carriers. And in 2021, JetBlue specifically announced that they would use these suites to try to compete directly with the legacy carriers on the New York to London route, which is one of the most profitable routes in the world. And this puts it a far cry from the budget airline model it was founded on. And even Southwest is rethinking some of its core aspects of the business model. The airline is experimenting with assigned seating, which could impact one of its greatest operational strengths, lightning fast boarding. Historically, open seating has allowed Southwest to achieve quick turnarounds, enabling higher aircraft utilisation. But if assigned seating adds time on the ground, it could result in the number of flights each aircraft completes daily being reduced. And of course, Southwest made massive headlines when they announced that they will, for the first time ever, charge for bags and reservation changes. This is a move that not only raises short-term revenue for bag fees, it also encourages passengers to check fewer bags, creating more space in the hold for highly profitable freight. And all of these fees are now on Southwest tickets, unless of course you hold a Southwest airline credit card. Most likely because Southwest would almost certainly like to be able to earn as much from credit cards as the legacy airlines in the US do. Credit card partnerships have become a huge cash cow for legacy carriers, with Delta earning nearly $7.4 billion from its partnership with American Express, a number that represents nearly 12% of their entire revenue for the year. Now, another noteworthy trend here is the shift away from small secondary airports. Low-cost carriers, which initially thrive by operating out of cheaper, less congested airports, are increasingly battling for gate space at the major hubs. Now, this shift raises operational costs and increases competition with the mainline carriers, but is often a desirable factor for customers, especially if they've connections to other flights. But on the other hand, in Europe, the low-cost model remains alive and well, with Ryanair definitely leading the pack. The more point-to-point nature of European travel lends itself to a low-cost airline model, and companies like Ryanair have stuck to its low-cost model and its strategy has paid off. Ryanair is now a bigger airline than many of the mainline carriers in the continent, and despite economic downturns, fluctuating fuel prices and the COVID-19 pandemic, it has consistently reported strong financial performance. And like Southwest, Ryanair has frequently used economic slowdowns as an opportunity to expand aggressively, ordering new aircraft at discounted rates and capturing market share while competitors pulled back. Their record-breaking order for Boeing 737 MAX aircraft in 2023 underlines their long-term confidence in the model in spite of its delays. Meanwhile, easyJet occupies more of a hybrid leisure position in Europe. While still fundamentally a low-cost carrier, easyJet offers a more leisure-style experience than Ryanair, and this approach allows easyJet to capture a slightly more premium segment of the market while still keeping fares competitive. Both Ryanair and easyJet showcase that low-cost model remains viable when executed with discipline and clarity. Globally, their success stands in contrast to the challenges faced by US low-cost carriers, underscoring that market dynamics, regulatory environments, and strategic execution all play critical roles. And where American low-cost carriers have struggled with rising costs and competitive pressures, Europe's low-cost giants have stayed laser-focused on their core strengths, proving that the model can work in the right market conditions. Looking forward, American low-cost carriers appear to be moving towards a hybrid model, mixing low-cost basics with premium features. The question here though is whether this evolution is sustainable or if it marks the beginning of the end for traditional budget airline strategies. Could a new ultra low-cost carrier emerge to fill the gap if these airlines shift too far upscale? Or will rising costs and passenger expectations prevent new entrants from replicating the bare-bones success of earlier low-cost carriers? Well, yes and no. The industry has been trending towards more consolidation in recent years, not less, and the market conditions for starting a new airline right now are tenuous as the industry is still not fully recovered from the effects of the COVID-19 pandemic. But that said, some new entrants with some familiar faces are trying some new and innovative approaches as low-cost airlines, particularly in the United States. Avalo is trying to beat Allegiant at their own game by offering point-to-point flights in underserved American markets with older 737-7 and 800s. And Breeze Airlines, which was founded by David Neilman, a serial airline entrepreneur and founder of JetBlue, among others. Breeze flies A220s and Embraer E195s point to point between smaller regional airports in what they see as underserved markets. Perhaps most interesting in this market is JSX, which is theoretically a charter airline who recently started operating some point-to-point regional routes. JSX flies Embraer E145s in an all-premium configuration, and its charter status means that passengers can clear customs and board the plane much faster. And on top of all of these, of course, there are numerous smaller boutique low-cost airlines like France's La Compagnie, which runs a tiny fleet of Airbus A321neos in an all-lie-flat business class configuration, and French Bee, which is operating a fleet of Airbus A350s. But the market for low-cost long-haul is too complex for us to get into in this video. You can see this video on the collapse of Norwegian Air Shuttle for a little more information on why these operations face more challenges than the typical low-cost airlines. Now, finally, there is the risk of brand dilution. With mainline carriers in the US, Europe and elsewhere offering low-cost options and some low-cost carriers offering more premium options, it's getting harder, from the passenger's perspective at least, to tell them apart. So maintaining a clear identity in both cases is becoming harder. If Spirit, Southwest and others continue down this path, they might find themselves competing more directly with the semi-low-cost or leisure carriers like JetBlue and Alaska Airlines, rather than sticking to the traditional low-cost space. And at the same time, legacy carriers like Delta and American may continue to refine their basic economy offerings, further blurring the lines between low-cost and mainline services. All of these changes together point towards an industry that is going to have to compete on price alone, relying on their operational efficiency and the advantages over major airlines. But there is the possibility that these changes can backfire. If low-cost airlines raise prices too much or complicate their business models, they could alienate their core customers, the travelers who expect a no-frills, budget-friendly experience. And the next few years will really reveal whether these moves are just temporary adjustments or the start of a broader transformation in the airline industry. Now, of course, this is still a bit of an oversimplification of the subject because, again, there's just too many differentiators between the carriers, even within the mainline or low cost or leisure groups, to assign them into neat little boxes. The airlines sort of shifting and moving where they fit in the market is kind of just how the airline market works. So perhaps a shift like this was inevitable. But what do you think? Are these changes good for us travelers? What happens next for the major leisure and low-cost airlines? Let us know in the comments below. Now, I'm Ben Watts. You've been watching Mentor Now. Have an amazing week, and I'll see you next time.